Welcome to the Lifestyles Unlimited Real Estate Investor Radio Show, a real estate investment program. Listen and learn how to use real estate to build wealth and passive income streams for you and your family. We bring you experts every day to discuss and answer your questions on everything from single-family homes all the way up to 600-plus unit apartment complexes. And now, the Lifestyles Unlimited Real Estate Investor Radio Show.
Welcome to the show. My name is Al Gordon, and as always, I'm working on your financial freedom. And I'll tell you what, I got an email from some of my fellow Lifestyles Unlimited members. I'm a part of a group that shares information. In other words, I think there's about 350 people in this little subgroup in Lifestyles Unlimited, and we meet together physically. We share information through emails. We help each other out. If somebody has a question, they post the question, and then when somebody has the answer, they'll post the answer that meets the needs of the question. And of course, everything that is communicated within the confines of our knowledge base, which was created by Lifestyles Unlimited for us. Yeah, Lifestyles Unlimited created my knowledge base for me, because before I came to Lifestyles Unlimited, I really didn't have I'll just be clear. I thought I knew what I was doing when it came to real estate investing because I had listened to other people share their wealth of information, only to find out that the people that I had actually been listening to really didn't know what they were doing. And as a result of that, my real estate investing lifespan in my early years was pretty mediocre. It was mediocre. I got mediocre returns. I got mediocre this. I got mediocre that. I didn't aggressively go after the 5 different ways I could have made money in real estate because I didn't know. Nobody had bothered to explain it to me until I came to Lifestyles Unlimited. They just laid it out very clearly, very succinctly, from start to finish. This is how you do real estate. These are the types of assets you focus on. This is why. This is why you shouldn't be in a 401k. This is why you shouldn't have IRAs. This is why you should have your money in real estate. That's really what it boils down to. I just gave you a 16-hour class. No, not really, but okay, there's a lot more to it. But that's what makes this group so interesting. Everybody in this group is a member of Lifestyles Unlimited. Everybody in this group has learned the same information. We have the same baseline of information that we work from. And when information comes out of left field, we address it. Now, what does that mean? Information coming out of left field. I guess that's slang talk. I probably shouldn't do slang talk on the radio, but I just did. So, oh well, get over it, right? All right. So information coming out of left field. Well, here's one right here. This is an article that was shooting around this weekend. There were some folks that interpreted this article as this might be the coming wave that we're looking for. This might be the absolute decline of real estate assets that we've been waiting for so we can pick up assets for 50 cents on the dollar. Some people were thinking that. Other people were thinking, yeah, not quite sure that that's what's going to happen. Because as you get into this article, you start to realize that they're talking about something called foreclosure. Foreclosure is a process where legally a property that you may have title to is taken from you because you failed to do the things that you agreed to do when you took title to that property. Yeah, that's what foreclosure is. It's a legal process to remove you from that asset. It's not a pretty process. Why do we have foreclosure? Well, we have foreclosure because there are entities out there that have a vested interest in your property. That vested interest may be in the form of a note. Maybe you borrowed money in order to own that property. Maybe you were somebody that had good credit and you wanted to own your own house and you had enough money for 3.5% down and you bought a house, FHA, 3.5% down, and you started living in that house. And over time, you made your mortgage payments and everything was going great. And then all of a sudden, something like, I don't know, a coronavirus shows up and it wrecks your life. It totally wrecks your life. You can't go to work because you're not classified as an essential worker, which means that you are instantly unemployed and you can't pay your bills. Yet you have a house now that you have to make payments on, right? Okay, so then you realize that, all right, well, I'm going to make myself an essential worker. I'll change jobs so that at least I can get income. And by the time that works out, you're maybe 3 months behind. So now what you've done is you've gone to your lender and you've said, hey, I'm 3 months behind. Don't foreclose on me. And the lender, trust me, the lenders don't want to foreclose on you. That's a huge misnomer. Essentially, if a lender forecloses on you, that's them admitting that they failed because they entered into a business relationship with you. They wanted to see you be successful. Remember, they got into this deal because they're making money off the interest that comes from the payments that you're making. That's their piece of the pie. And when you're not making those payments, they're not getting their interest payments, so they're not making money. They're also not recovering the principal that would be paid down, and it becomes problematic. So one of the things that lenders decided to do was they went into this practice called forbearance. Okay, and forbearance is essentially the step before foreclosure. That's probably the easy. And I'm not an attorney here, okay? And I don't play one on the radio. And if you're an attorney listening to me and you know all this stuff, and I'm missing the mark, I'm not getting it 100% accurate, send me an email at askal@luinc.com. Tell me what I got wrong, and I'll be more than happy to articulate it in a future show. But I'm not worried about the details. See, what I'm worried about is the fact that people went into forbearance. And there were a lot of people that went into forbearance. There were a lot of people that were affected by the shutdown that occurred 2 years ago in this country. A lot of people. But most of those people that went into forbearance had made an agreement with the lender to keep them out of foreclosure. Now, the one thing you're probably wondering is, what is this article about, Al? Well, it's about the fact that foreclosures are up 40% month over month. Let's talk about it when we get back.
Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. Now, let's get back to your map to financial freedom.
Welcome back to the show. All right. This article is entitled U.S. Foreclosure Activity in February 2022 Continues to Increase Steadily. The article itself is, I want to give you the source. I'm going to have to zip down through the email because I did not get the source data on this. Okay, I owe you source data, and I promise I'll get it to you at the break. But article itself starts off like this. ATTOM. Have you heard of them? ATTOM? I mean, they're a household name, right? Yeah, you've never heard of them either, right? Okay, so who are these guys? Well, they are a licensor of the nation's most comprehensive foreclosure data, and they're actually the parent company to something called RealtyTrack. Now, you've probably heard of RealtyTrack. RealtyTrack is what I would consider a huge online marketplace for all kinds of stuff. I mean, they actually will post foreclosure data on there. They'll post information about distressed properties on there. And one of the things that they did not too long ago is they released a report that basically said in February of 2022, the United States foreclosure markets indicated that there were a total of 25,833 United States properties with foreclosure filings. What is a foreclosure filing? Okay, well, maybe they had a default notice posted against them. Maybe they've got a scheduled auction identified for them. Maybe it's a bank repossession. Okay, and there's different things. And what this article is saying is that number was up 11% from a month ago and 129% from a year ago. It would seem to indicate that foreclosures are just ready to just pour out into the marketplace. I mean, that's kind of what it sounds like, right? But let's digest this data a little bit. And let's think about what was going on a year prior to this. There were people that were in the foreclosure process. There were people in the forbearance process. Many of those people that went into the forbearance or the foreclosure process came out. It means they cured whatever the problem was. For many people that got behind in payments through no fault of their own, because, what happened in this country 2 years ago, they lost their jobs. They couldn't go to work. Their livelihood was ended, and they had to find a different way to earn income. And a lot of these people found different ways to earn income, but the damage had been done. They were 2, 3, maybe 4, possibly more payments behind. And the problem with that is when you get behind, your lender starts getting a little worried about you. They get very worried about you because they start thinking that, oh man, we should have never loaned money to this guy. What were we thinking? Fortunately, this country did not completely lose its mind. Lenders realize that, first of all, foreclosure is an expensive proposition. Okay. It is not something that causes your bottom line to go up. Okay. So they don't like it. They really don't like it. They'll do it if they have to, but they really don't like it. There are other ways that they can work with you to even all this stuff out. And one of the things that most lenders did was they said, look, you're 4 months behind. Here's what we're going to do. The interest that was due, poof, we're going to make it go away. All right. We're just going to forget about it. And it'll be our gift to you. All the principal that you should have paid down that you didn't pay down, we're going to add it to the back of the loan. And other lenders did it different ways. They said, look, we're not going to mess with the principal or anything, but we're going to take the interest that you should have paid, and we're just going to add that onto the back of the loan. So in any formula, and I'm not telling you how these formulas work because I'm not in the lending foreclosure world. I'm not in that world that works these little deals out. The lenders, however, understand that most people who were affected by the coronavirus didn't choose to be affected by the coronavirus. They didn't. And because so many of us were affected immediately at the same time, lenders couldn't do business the way they used to do business because all of a sudden now there was a big danger to them because all of a sudden there's a lot of properties out there that they have loans on that people aren't making payments on. Kind of messes with their bottom line, don't you think? So what about this article? This article that says foreclosure filings were up 11% a month ago and 129% from a year ago. Those numbers sound like they're super, super significant, don't they? 11% increase over last month. 129% increase over a year ago. That's like everything's fallen apart. Except what happened a year ago? Nobody was being foreclosed on. Barely anybody was being foreclosed upon. Lenders were doing everything in their power to keep you in your home, keep you in your note, and to not take you through a nasty foreclosure process that nobody wins in. Let me just read to you directly from the article. And this is a quote from the article. It says, February foreclosure activity looks a lot like what we can expect to see for at least the next 6 months. Double-digit month-over-month growth and triple-digit year-over-year increases. Now, this is a statement that was made by Realty Tracks vice president, a guy by the name of Rick Sharga. He goes on to say this. He says, this isn't an indication of economic turmoil or of weaknesses in the housing market. It's simply the gradual return to normal levels of foreclosure activity after 2 years of artificially low numbers due to government and industry efforts to protect financially impacted homeowners from defaulting. He backs me up. That backs up my statement. Everything that I just told you, Realty Track agrees with me. And here's the point. If foreclosures happen, and foreclosures will happen, It is a normal functionality of the real estate business. There are individuals out there that, for whatever reason, choose not to or just cannot meet their obligations. Something happened in their life, a life-changing event, whatever it is. And it created a problem for them that maybe would lead them to a foreclosure process. So here's the point I want to make. Don't start salivating too much. 2008 is not around the corner, nor is 2009. But 2022 is. When we come back from the break, I've got more on that. Stick around.
Del will be back in a moment. But first, this intel from the files of Del Walmsley.
I kind of look at running businesses like spinning plates on top of a pool stick. Jugglers do this. They spin a plate and they get that one going and they run over to the next pool stick, put a plate up there and spin it. They get 4, 5, 6 plates. And somewhere along the line, you realize there's too many plates and you can't get back to all of them quick enough to keep them spinning at the right velocity. And then you have a crash. And that's what happens with all this. You have that crash. Then that crash is the first time when you open your eyes and go, I need a new system. Because if I don't have a new system, the old system is inadequate as far as results go in allowing me to juggle that many plates. I'm going to need a new way to do this. And I'm going to have to figure it out before I can ever grow my business, myself, my relationships, anything out there.
More of the Lifestyles Investor Show is coming up.
Warning. Listening to the Lifestyles Unlimited Real Estate Investor Radio Show will change your life. We will teach you how to create wealth and passive income so you can be financially free. And now, back to your host.
Welcome back to the show. All right, I probably burst your bubble in the last segment, and I apologize for that because I know there are those of you that are out there just waiting for the bottom to drop out of the real estate market. You're thinking that if something like 2008 occurs, there's going to be a couple of years of really good buying opportunities. Because what happened in 2008 was, the market did drop through the floor. It did. And it was the result of, the government doing stuff that the government probably shouldn't have been doing. But if you circle back on how 2008 really occurred, it all started in the 1970s with a desire by the federal government, by the political parties in this country, to ensure that every American citizen had the right to home ownership. That was no longer a chicken in every pot. That was a 1930s thing. 1970s and 80s thing was, hey, home ownership. And they started Mickey Mousing around with some of the lending policies, some of the laws that govern lending. And, it just kind of built up over time. And next thing you know, we're in, 2005, 2006. People are getting loans that they have no business getting. They don't qualify for them, but the lenders don't care because all the lending restrictions are gone. So now we're in this feeding frenzy where people are just buying properties and it's a supply and demand thing. And we just kept pushing prices up and up and up and everybody was making money. And all of a sudden the top hit and boom, it was over. And that happened in 2008. And then the markets, they couldn't keep up anymore. The people that had been buying all of these properties were realizing that, I don't know what I'm doing with these properties, and they're not going up in value, so I need to get rid of them. So what they do, they took the keys to the properties, they put them in an envelope, they put the name of their lender on the envelope, and they mailed the keys back to them. Yeah, it was called jingle keys, and it was going on like crazy. And you know what happened? It started a foreclosure process in this country, which, it made all real estate go on sale. It did. There's no getting around what happened. A lot of people were severely damaged by what happened in that market space because they were normal people like you and me. I was one of those normal people. I had bought a house. It was $700,000. It was a fixer-upper. Tina and I put 20% down. So we had $140,000 into that house. Okay. And then we put another $200,000 into that house. Now we're in for $340,000 out of our pockets. The property, we're all in at about $900,000, right? We know that the value of that home is about $1.1 million when we got it all fixed up. And we're going to live in this property because this is our personal property. And everything was going swimmingly until January 2008 occurred and the market imploded. And then I, as a military guy, I got transferred. I got transferred 4.5 hours away from where I was living. And I couldn't sell my home. I had to do something called geographical bachelor. And I will tell you, you might as well go to prison because that's probably easier than doing geographical bachelors. And those of you that have done the geographical bachelor thing, you know exactly what I'm talking about. And those of you that don't know what I'm talking about, if anybody mentions geographical bachelor to you, don't do it. It is not something that will help grow your relationships in your family unit. I'm just telling you. So when the dust all settled on us, okay, I finally was able to sell that house. I think I was able to sell it in 2009, and I had to do a short sale. Now, get this. You want to know what I sold it for? $365,000. $365,000. And you know where all the proceeds went? Well, it didn't come back into my pocket. It went to the bank. Yeah, the bank kind of looked at it as, okay, well, they took it in the shorts a little bit too because, well, I had a mortgage on there for what, $560,000? So they lost a couple $100,000. I lost about $340,000, $350,000 in that meltdown. And here's the thing. Even though I went through that meltdown, I was not positioned the way I am now to be able to take advantage of that market if it does melt down. See, I'm in that position right now. And that's what part of this chatter is in the email chain about this particular article. We're all interested in knowing what the health of the markets are. Just because people throw statistics out there, we're educated enough to analyze the statistics and understand what the statistics are really trying to tell us. So check it out. This article says that there were 2,634 United States properties that went through the complete foreclosure process. That meant 2,634 properties, and let's just assume they're all single-family houses. I don't know. They don't articulate that. We'll just assume it's just houses, just single-family houses, one family per house, per lot, okay? 2,634. That's not a lot. That's really not a lot. I mean, let's annualize it. What's that, maybe 30,000 houses a year? Now, the article's saying, hey, be prepared for the numbers to start, ratcheting up. And I agree, the numbers probably will ratchet back up because we're starting to get back to something that looks a little bit closer to what we were used to before, well, the world basically shut down for 2 years. 2008 is a completely different scenario than 2022. It is. Now, I know there are other people out there that maybe you listen to that are talking about, hey, I'm waiting for the fall to happen. And you know what? I'm no different. I am waiting for the fall to happen. I have dry powder that's ready to go in case real estate goes on sale. But I'm not just sitting in my chair here twiddling my thumbs waiting for the markets to fall, because I don't think that's going to happen. 30,000 properties a year going into foreclosure, that's a drop in the bucket. Now you're saying, whoa, hey, hold on, Al, 30,000 houses. Well, that's a small town in Texas. And I'd agree with you. That is a small town in Texas. But this is the United States of America. We got a whole lot more real estate than one tiny small town in Texas. Do you get my point? Yeah. So what I'm seeing here is that all the players in the markets Nobody wants 2008 again. I don't want it to happen again. Trust me, it took me a long time to dig out of that hole. And I finally dug out of that hole. I don't want to go back into that hole. But if that hole is created for me, I will jump in with both feet. I will jump in with both feet and I will start buying assets on sale. But assets aren't on sale. Assets are not on sale. As a matter of fact, assets are going up in value. I don't know what's happening in your neck of the woods, but in my neck of the woods, one of the things that I'm doing is I am selling off my single family assets. I'm selling them off one at a time. And I'm taking the money from that single family asset and I'm buying apartment assets with the money. And here's what I am experiencing in my little piece of the marketplace. I'll put a property on the market on a Friday. I went to Expo, hung out with 5,000 like-minded real estate investors, came back from Expo, had 16 offers. I selected one of them. I'll tell you what the deal was when I come back, because you won't believe it. Stick around.
Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. It's time to turn up the volume and fine-tune your passive income plan so you can create the lifestyle you've always wanted.
Welcome back to the show. All right, I'm going to spill the beans here because I'm just going to tell you what's going on in the real estate markets. I'm also going to tell you that if you own single-family assets and you are considering selling those assets, whether you live in that asset or whether you own that asset as a business unit for yourself, I think now's a really great time to sell. I really do. Because we're in a hardcore seller's market. Yeah, it's a hardcore seller's market. And it's been this way for quite a while. And I'm not seeing any signs here that are indicating to me that we need to hunker down and get ready for things to go on sale. 30,000 properties going into foreclosure is a drop in the bucket, considering what this country has experienced in past years. I'm not even going to get into those numbers. But here's what I think is very interesting. There are certain places that are feeling the foreclosure pressure, and there's other places that aren't feeling the foreclosure pressure. And why do you think that is? Do you think it's because people have gotten themselves into a financial situation where maybe they've taken on more property than they can handle and they didn't have the contingency plan if something went wrong? I think that's possible. I think it's plausible. I think it's an exact example of what I went through, where market forces are creating certain pressures on an individual and their family and their asset. And if they're not organized correctly, it can be detrimental. So here's my point. I'm selling single-family assets because I have determined that I will do better owning multifamily assets. Yeah, that's just my business plan. That's my game plan. That's my roadmap. That's what I'm doing. It's all based on everything that I was taught at Lifestyles Unlimited. It's based on talking with my mentor and saying, am I stupid? Am I missing the mark here? And that's what I love about my mentors. I can just go eye to eye with him and go, all right, man, this is where I'm going. Tell me where the wheels are going to come off the train. And that's what the mentor does for me. He tells me, hey, that's a good idea. Or, hey, consider this because you may walk into problems if you do that. Well, he agrees with my game plan. He does. And part of the reason he agrees with my game plan is because he's doing the exact same thing, except he doesn't have any more single-family assets. Instead, what he's doing is he's selling smaller apartment communities and then buying bigger ones. That's how this real estate thing works. It's not, hey, go out and find a house, buy it, and sit on it for 20 years. And I understand why Dave Ramsey explains it the way he does. because Dave Ramsey is interested in helping you with basic financial needs. And I think that's very important. I have no ill will towards Dave Ramsey. I think Dave Ramsey provides a very valuable, beneficial service to Americans. He teaches them things that they don't hear elsewhere. But what he teaches is only going to get you to a certain place. If you truly want to achieve retirement in the next 5 years, you have to break away from that mindset, because that mindset that you have that says it's going to take you 30, 40, 50 years to retire. We don't believe that. As a matter of fact, I've got case after case I can explain to you with people that are members of Lifestyles Unlimited that have done it in 5 years or less. It's not that difficult, but it does require you making a decision to make a change in your life, to do something a little bit differently than you've been doing, to maybe consider information that nobody else has bothered to share with you, and to use that information to make dramatic changes in your life. Yeah, pretty cool. All right, let me get back to this house. All right, so Tina and I, we sold one house earlier this year, and we did pretty good on it. It was a property that I listed for, I think it was, what did we list it for? I think $225, and it sold for, I don't know, $250, $255, something like that. We did really well on it. So we owned the property right next door to it. And actually, the property next to it was, in our opinion, was an even nicer property. It was even nicer, although it was a little bit smaller. It was nicer than the one that I sold next door. So we decided we would put it on the market. So we checked the comps and everything. We thought $235 would be a good price. We felt that with an appraisal, maybe we could get it to $240, possibly $245. I mean, that's what the market indicators were telling me we could do. Tina and I decided to go ahead and sell the property. And the reason we did was we had put a strike price on this property of $225. We bought it for $174. And my game plan was, as soon as I made $50,000 in equity, I would sell that asset, because once I had $50,000 more in equity, my returns would start to diminish, because that equity is not doing anything to cause income streams for me. And that's part of the reason you sell a property or refinance the property. Now, we had considered renting this property back up. As a matter of fact, we realized that we could move the rents easily from $1,400 to $1,600 a month. And that would have been an extra $200 a month increase in our household. Okay, not terrible. It's an extra $2,400 a year for not doing a whole bunch of anything, to be honest with you, because the house is in great shape. It's good to go. But once we realized the market forces were telling us that we could list it for $235, that was $60,000 above what we bought it for. Does that make sense? Okay, so natural appreciation has caused a $60,000 increase in value in this property. We put the property on the market. I had 16 offers. I had a bunch of offers that were typical FHA 3.5% down offers, good offers, people trying to offer the best that they could to position themselves the best they could. And there was one particular offer that came in. It came in $25,000 above what I was asking. It was all cash, no contingencies. $5,000 in earnest money, hard, because there's no contingencies. Well, there technically is a contingency. It is subject to them selling their home where they're leaving. And they gave me all the sales data. The person buying their home is well qualified. There's no reason why that person won't close on the deal. So I took this person's offer. So now we're at $265,000 is our price. And that is an example of what is going on in this marketplace. Now, I'm not telling you all this stuff because I'm bragging about the fact, I made an extra bunch of money on an asset. I was able to push the pricing up. Okay, I was able to do that. I was able to make a property compete very well in the marketplace, and I was able to identify a ready, willing, and able buyer that was willing and so desperate to pay a lot more for the property that they came in with all cash, no appraisals, nothing. Now, they did some inspections, and I was fine with that, totally fine with that. But anything they found was wrong, it's kind of on them. It's on them to remedy it. So at the end of the day, on Friday, we're going to go to title and we're going to go sign paperwork. So let me explain to you what this asset has done for us so far. We're going to net probably in the neighborhood of about $100,000 to $105,000 coming off this property. Now, this is a property that I bought from another Lifestyles Unlimited member about 15 months ago because I was coming out of a 1031 exchange. I was selling a property that I owned for a very long period of time that I was operating or had been operating based on not knowing what I was doing. Once I became a member of Lifestyles Unlimited, we remedied those properties. We turned around a negative cash flow into a positive cash flow, and then we positioned them for sale. Because we had so much equity in those properties, we were concerned about paying a lot in taxes. So we did a 1031 exchange into this follow-on property. Now, this particular property that we just sold, we did not do a 1031 exchange on because I plan to take the proceeds and buy more apartment communities with them. And because of the way I'm buying the apartment communities, I can't line up the tax ID numbers. So therefore, I have to stop right here with my 1031. And you might be thinking, oh my goodness, Al, you're going to get the double whammy effect of the fact that you never paid taxes on the previous property, but they're still due when you sell this one. And now you made a lot of money on this property, so you're going to pay a bunch of taxes, but you're not holding any money in reserve, are you, Al? And I'm not. And here's why. Because all of the apartments that I'm buying into are going to throw off massive amounts of cost segregation, depreciation, which is going to take care of my tax problem for me. This is the beautiful thing about real estate. And I'll tell you what, I'm not worried about foreclosures. When they happen, they happen. If they don't happen, I'm going to be fine. But I'll tell you this, you won't be fine unless you get on board with what we're doing.
Now, from the files of Del Walmsley.
You buy a rent house and we go buy a 10, 15,000 below market to start with. Used to be 25 or 50,000 below market. But let's just say 10 or 15,000 below market. So we make an instant $10,000 on, let's say $25,000 down. So we've already made a 30 or 40% gain on our investment the day we bought it. We own the house. If we want to, we could sell the house for a profit right now because we can. Not in a 401k you can't, because you have to pay penalties and interest and taxes and all kinds of stuff. But I could sell the house right now. I could do 1031 and take the capital gain and pay no taxes on the capital gain. Or I could hold it and rent it. Now, for 30 years, while you're paying $500 a month into your 401k, my rent house is paying me $500 a month to own it.
Go to lifestylesunlimitedworkshops.com and let's get you started.
The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented on the Lifestyles Unlimited Real Estate Investor Radio Show constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.